Hello and welcome to the latest Moneymakers Weekly Investment Trust podcast. I'm Jonathan Davis, the editor of the Investment Trust Handbook, and your host for this weekly review of all the latest news and developments affecting the investment trust sector. My thanks to J.P.Morgan Asset Management for agreeing to sponsor the podcast, which as a result will now remain free for the foreseeable future. Moneymakers is an independent research and publishing venture with a mission to explain and inform. But I must remind you that for regulatory reasons, nothing you hear from any speaker today should be regarded as constituting individual investment advice. In the equity markets this week, there was another strong performance from the Nikkei index in Japan, which was up 4% on the week and is now up more than 30% over the last 12 months in local currency terms, though only 18% in sterling because of the continued weakness of the Japanese currency. China also picked up a bit more momentum this week, while the FTSE All-Share Index managed a 1.6% gain, despite the latest figures of economic growth from the Office for National Statistics, which suggested that the UK experienced a mild technical recession in the second half of last year. Though bear in mind that these figures are notoriously unreliable and are frequently adjusted subsequently. The US market, in the shape of the S&P 500 index, however, which recently passed the historic 5,000 mark, a new all-time high, for once lagged the other markets, down 0.5% in the week, following some disappointing inflation figures. In the bond market, gilts were again marked down for most maturities as yields pushed higher, with around half the issues still offering a gross redemption yield of between 4.5% and 5%. Oil and copper edged a little higher, while it was another bumper week for Bitcoin, which was up a further 13% to just shy of $52,000 as US investors continue to pile into the recent Bitcoin ETFs that have now been approved by regulators. The amount held in Bitcoin ETFs is now already about a third of the amount held in gold ETFs, and this week we saw the gold price, in contrast, slightly down on the week. The investment trust index was also up this week, but only by a fraction of 1% as the average discount widened out to 16.4%. The sector did, however, win some plaudits from Bose Weinstein, the founder of the activist investment firm Saba Capital, which we've spent a lot of time talking about in the last few months. He told an event at the London School of Economics why he loved UK investment trusts so much. Not just, he said, for their current wide discounts, the best arbitrage opportunity he's ever seen, he said, but also for the strong corporate governance and the fact that, unlike the US, boards and companies over here play by the rules. Well, I guess that is good to know, though not entirely consolation for the recent relatively poor performance of the investment trust sector as discounts have widened. There were results from half a dozen or so trusts out this week, with the most notable performances coming from Brunner, ticker BUT, the Global Equity Trust, which beat its benchmark by 3% for its latest 12-month period, and from City of London, ticker CTY, the old warhorse of the UK equity income sector, which was up 6.5% over its latest 6-month reporting period, a little bit ahead of the 5.2% return of its benchmark, the FTSE All-Share. There was less impressive relative performance from Scottish American, ticker SAIN, popularly known as Saints, which reported an NAV total return up 11.8%, but that was behind its benchmark by around 4%. Also, results from Polar Capital Global Financials, ticker PCFT, from Diverse Income Trust, ticker DIVI, and Brown Advisory US Smaller Companies, all of which reported single-digit losses in their latest reporting periods and reporting behind their benchmarks. While we also had updates from a number of renewable energy trusts, all of which reported lower NAVs at the end of last year on the back of falling power price assumptions. On the corporate side, the big news was the announcement that Tritax Big Box, ticker BBOX, the logistics specialist, has proposed an all-share offer for UK Commercial Property REIT, ticker UKCM, a deal in which Aberdeen, which manages UKCM, has a double interest, having not so long ago acquired a majority 60% in the management company that runs Tritax Big Box and its sister trust, Tritax Eurobox. Intriguingly, perhaps in this particular case, the chairman of UK Commercial Property, Peter Pereira Gray, was notable for declining to say that he would recommend the bid should a firm offer be made, while the other 4 directors of the trust said they would be recommending it. Would have been fascinating to be a fly on the wall at that board meeting where they discussed the deal. I discuss this and some of the other important news from the sector with regular guest Andrew McHattie in a moment. Elsewhere, we learned that J.P.Morgan Global Growth and Income, ticker JGGI, is proposing to raise up to $40 million at a small premium to NAV in a placing in order to help meet a wealth manager's demand for a large chunk of shares. That offer, which is also open to retail investors, closes on Tuesday. Meanwhile, Bluefield's Solar Income Fund announced it would be launching a £20 million share buyback programme in an attempt to reduce its persistent discount. If you want more detail on any of these or all the other announcements that have come out from the trust sector this week, you can find them as usual in our weekly email to paid subscribers to the Moneymakers Circle, together with our latest trust profile, which features J.P.Morgan India, ticker JII, as well as details of the latest two trusts I've added to my favourite funds page. I should add that we will be producing a second short podcast segment, a conversation with Laura Foll, co-manager of 3 UK investment trusts that are managed by Henderson's, early next week, it having been rescheduled from this week. So please look out for that. So my first question when I caught up this week with Andrew McHattie, editor of the Investment Trust newsletter, for another of our regular reviews of what's been going on around the sector, was how does he characterise how the new year has begun? A lot of talk in the autumn about more confidence about the outlook for investment trusts as discounts seem to be coming in a little bit, but it hasn't quite worked out that so far this year, has it, Andrew?
It hasn't, Jonathan, no. I think we had quite a lot of optimism around the new year, and we enjoyed a traditional Santa rally in markets in December, didn't we? But I think that new year optimism has dissipated quite rapidly, and sadly, markets have retreated a little bit. I think they're still very, very sensitive to interest rate expectations, and any setbacks that we've seen in terms of US inflation being higher than expected, for example, has knocked prices back, and we've seen discounts widen in the sector again, back out to about 16.6%, which is a bit disappointing, but that's where we stand at the moment.
Yeah, so most of the damage, so to speak, in the performance of the investment trust index, which is, I think, down around 2% so far, year to date, has been concentrated in those sectors which are deemed to be yield sensitive. So infrastructure and property in particular have seen prices coming off, and that's a combination of factors, I guess. But in terms of the rest of the sector, in terms of the general equity trusts, it's been a bit more pedestrian, shall we say, rather flat, I would say.
I think that's a good characterisation of it. It's been a continuation, really, of the trends that we saw for much of last year, where you have a lot of price action and new price discovery going on in the alternative asset sectors. So we are seeing, indeed, infrastructure and real estate being quite weak again. But you're right, in the equity sector, we haven't seen very much excitement, which is generally the way we like it. And trusts are just getting on as normal and hopefully will provide some returns for investors as the year progresses.
One of the differences between the infrastructure sector and the property sector is there's been a lot of corporate activity in the commercial property sector, whereas in the renewables we haven't seen much of that at all, so far anyway. We've just seen everybody ploughing on, and their NAVs have been coming down a little bit because of power prices down and so on, and bond yields are up. But we have seen another corporate action in the property sector. It's quite an interesting one, this one. So tell us about the proposed merger between UKCM and BBOX, in other words, Tritax, Big Box, and UK Commercial Property. Tell us the background to that one.
It's a big one, this one, and therefore quite meaningful. I think it has been called a mega merger by some, and it will create a company that will have a market cap of around £4 billion, which places it pretty close, actually, to the FTSE 100. And so this is quite important to talk about. Now, Tritax Big Box is well known, actually, as a large warehouse trust, whereas UKCM, UK Commercial Property Trust, is an Aberdeen-managed trust that has traditionally been a generalist, but it does have some bias towards these logistics assets. Anyway, Tritax Big Box is wanting to merge with UKCM, effectively taking it over. And this is interesting because this is not the first approach that UKCM has had. And actually, late last year, it rejected an approach from Picton Property Income, which seemed like quite a sensible combination to me, but it was rejected by Phoenix, which is a very large shareholder in UKCM, so that effectively prevented that deal. But Phoenix and Investec Wealth have both agreed actually to this new deal in principle. And because they account for 56% of these shares, it's effectively a done deal now, I think. And it makes sense for Aberdeen, who do majority own Tritax. So actually there's a bit of continuation in the management there. And so I think it's very likely this merger will go ahead. And I can see it makes sense in terms of the liquidity. It makes sense for the managers. And it makes some sense for UKCM shareholders who've had a little bit of an uplift. I'm not completely convinced, though, it makes great sense for Tritax big box shareholders, because there's still around 40% of the assets that they're acquiring here are non-industrials, so they're definitely non-core. And the managers will have to deal with those, and it's not a great environment, I think, for disposals. So they have some work ahead.
Yes, it's interesting. I mean, the share price reaction, I think, has been pretty much as you expected. We've seen UK commercial property go up and Tritax big box go down. I think the shares have come down a little bit. Would one be ultra conspiratory theory here to think that Aberdeen is basically behind this deal and they've managed to persuade Phoenix to accept their deal rather than the other one? Because Aberdeen have an interest in basically all the parties to this one, don't they, I think, essentially.
Well, perish the thought, Jonathan.
I know. What a terrible thought to put forward. I'm so sorry.
I mean, far be it from us to comment on that. One thing that I was reminded of was the rather brilliant comment that Marcus Fairmudge made on your podcast a couple of weeks ago, talking about the Hoover and the dust, and how actually you're much better owning the dust in this sector than the Hoover when trusts are combining. And we've seen actually on a few occasions now that the acquiring trust tends to do quite badly in the short term. The shares do tend to go down. And in the case of Custodian REIT, for example, there's been quite a significant drop-off in the shares there. And we've seen this in other sectors. So I'm starting to think, Jonathan, that if you do own a trust that is making the offer, and in particular, if it's an all-share offer where you might see an overhang of stock, you're best off selling. So I'm not convinced, actually, that in the near term, this trend towards mergers is necessarily a good thing for all shareholders.
Yes, I think that's a fair comment. Custodian has been particularly badly received, I think, or at least in terms of the shares are down, 20%, something like year to date. I'm looking at that, which is not exactly a vote of confidence from the market. But as you say, you've got to be quite tactical about it if you are a shareholder in one of the two. Obviously, if you're a shareholder in both, it's not quite so bad. Are we running out of opportunities now for more consolidation in the commercial property sector, do you think? The list is narrowing. Anyway, it's narrowed quite a lot. We've had about 4 or 5 deals in the last 12 months from memory. Do you think that if you haven't gone already, you're too late to the party kind of thing, if you're one of the struggling commercial property trusts?
Well, there could be a few more deals on the cards. Of course, some of this is driven as well by advisors who get paid every time there's a deal. And they haven't been able to promote any IPOs, of course, for a long time. And therefore, actually, they're heavily incentivized to make sure that there are other forms of corporate activities so that they stay busy and stay in the money themselves. So, no, there could be a few more. I think it's not necessarily a good idea to be buying new holdings, though, on the basis that you think they might be taken over. That's a very risky way of operating your portfolio. And I think as well, it's often disappointing because you end up with a low quality portfolio with absolutely no guarantee of any uplifts. So it's one thing owning things that maybe you've held for a while that are potentially takeover targets, and so you're holding on to them. But it's something entirely different to make new purchases in that way. And I think that's something I wouldn't recommend.
Well, let's talk about fundraising. You mentioned the absence of IPOs. There's now been 2 years of effectively of a drought. But we have seen 1 or 2 little signs that it is possible to issue shares, at least as secondary issues. And we've had a couple of examples of those in the last couple of weeks or so. We've had JGGI, that's J.P.Morgan Global Growth and Income, and Invesco Bond Income Plus, BIPS. So what do you think that tells us? I mean, the sums are relatively small, but interesting nonetheless.
Well, it is interesting. And I think this is a nice segue, actually, because, of course, what's going on in the property sector is that there's a bit of a land grab going on. And it's a way of growing your assets during a time when you can't raise new capital to undertake these mergers. And we have seen these 2 trusts actually finally, raise some fresh capital from investors. And it was great to see, actually, Invesco Bond Income Plus raised 13.3 million when they were looking for 15 million. So they got nearly everything they wanted. And that was very much an opportunistic capital raise because of another trust in the sector, Henderson Diversified, which was returning capital to shareholders. And so Invesco Bond Income Plus thought quite wisely, well, we can grab a little bit of that money. And they did so successfully. I think as well, the J.P.Morgan Global Growth and Income Trust is also being opportunistic because it's raising up to £40 million, basically on the back of an inquiry from a large wealth manager who wanted to obviously put in a decent sum of money. And so they're issuing new shares now at a small premium to NAV, 0.6%, which is actually quite similar to the market rating. So the benefit for you is that you save a bit of stamp duty if you come in through the offer. And you'd need to be quick because it closes on Tuesday. But also it means you can actually get in if you're a big buyer. So it's not that significant, I don't think, and it's not because the manager is seeing marvellous opportunities. Actually, I heard from the manager this morning, and they said that they feel that global markets are pretty much on an average rating at the moment, so the trust is not geared. So the reason for the fundraise is not that they're seeing a tremendous opportunity in markets, it's just to fulfil this demand. But nevertheless, I'm pleased to see it happening, and so I don't want to be negative about it.
Yes, I mean, it's fair to say, I think that 40 million is pretty much a drop in the ocean compared to the size that this trust has now become, 2.4 billion. It's been busily consolidating, as we know, with the Scottish Investment Trust and another J.P.Morgan Trust and so on. So it's doing a great job, and its shares are up again 7% this year. So it's doing extraordinarily well. One has to hope that it continues. We have to mention, I guess, some things that haven't been going quite so well. And perhaps top of that list this year has been the battery storage trusts. They're in the renewable energy sector. Obviously, there's only 3 trusts that are wholly exposed to battery storage, though 1 or 2 others are looking to get into that business. What do you think's been going on here? There was a lot of bullishness before Christmas about this sector. We had one of the managers on the podcast talking very positively about it. But unfortunately, it's all come sort of crashing down, hasn't it, in the last couple of months?
It's a salutary tale about what could happen in these specialist sectors, I think, and the batteries have run flat very quickly here, haven't they? It's been a really quite shocking decline, I think, especially for investors who had bought into these trusts as high-income trusts that were intended to be quite reliable and really something that was going to function, I think, quite independently of equity markets and really should have been a really solid part of the foundation of renewable energy in the UK. But we've seen these very sharp declines in share prices. I had a look yesterday and the share prices just in this calendar year to date, so just in a few weeks, the share prices of those 3 trusts were down by between 26% and 58%. So really nasty declines here. And I think it's very reasonable to ask what on earth can have gone so wrong so quickly. And I think in part, of course, it's just the market functioning that there's been a big sell-off as more news has been discovered here. But I did attend a very interesting seminar, actually, by an energy specialist who was not linked to these trusts, but was talking about the market and the background. And it seems it's a very unfortunate combination here of lower power prices, which are definitely trending lower in spite of what our domestic bills might tell us. The way in which these battery trusts are interacting with the national grid, who's the only buyer here. I mean, they're the ones with the power, and they've been changing their software and their systems. And unfortunately, that's really worked against the battery storage trust because they've effectively been frozen out of much of the balancing that they were expecting to participate in. So their revenue has really dropped off. And this has happened at a time when a lot of battery storage has been coming onto the grid. So there's been market saturation as well. So those 3 factors, really, the lower power prices, the unfortunate revenue balance with the grid, and also the market saturation, has meant that their revenue really has dropped off very sharply. They're unable to fund their dividends in the case of Gresham House and Harmony Energy. And this is now looking like a distressed sector.
It is, isn't it? And it's interesting because, of course, part of the story, I mean, I guess one of the reasons why there's a lot of interest before Christmas, because it actually sounded like a very good story. They were going to change the protocol or the system by which battery storage can be plugged into the national grid with a new system introduced by the national grid. But, of course, it's been delayed, I think, and not working quite as expected. And dare I say it, it's possibly a kind of public sector story here. I don't know. It's not working very efficiently anyway. And so there's been big disappointment there. combined, as you say, I mean, the revenue drops are dramatic. I mean, £25, I think, compared to over 100 at one point last year, which is, a big hit for anybody. So what do you think is going to happen? I did notice that the directors of one of the trusts have been buying some shares, which is a suggestion perhaps that the market reaction has been a little overdone. But as you say, the market has given its verdict and it's very uncomfortable.
It is very uncomfortable indeed, actually. And I think that you have to be quite bold now to rate these things a buy. But actually, I'm tempted to do so because you're quite right, actually, that directors have been buying. But I think there's more to it than that. I think fundamentally, the National Grid is going to want to re-establish a much better relationship with these trusts. And these trusts are very significant. They account for around a third of the battery storage capacity in the UK. And of course, as there's more renewable power on the grid, you are going to need these balancing mechanisms, and batteries are going to be important in the future. So I think there's going to be some attempt to repair this relationship and to change the algorithms to include batteries much more. It could even be that there's going to be a bit of a windfall if National Grid feels it has to provide a bit of rebalancing in favour of the battery storage trusts. We've seen that before, and actually 2022 was a particular high point for the revenue of these trusts because they have had quite a number of different contracts and a different revenue mix over the years. And so we could definitely see it improving quite sharply one more time. That's not the current market expectation, which is why you've got these share prices languishing. But I think these are fundamentally good assets with a reasonable future. And so I wasn't that surprised, actually, when I read a note from the broker Stifel that reckoned that Harmony Energy could well be a takeover prospect. And so whilst we were talking about the lack of corporate activity in the renewable sector, it could be that the pendulum will swing that way, Jonathan.
Yeah, that's interesting, yes, because I said earlier, I mean, one or two of the other trusts are looking to move into battery storage, but I guess one of the issues is that the ones that have been worst affected are both wholly concentrated in the UK, which has been where the problems have been. And as you said, I think it's not just the fact that the market, there's lots of potential supply, but it's the fact that I think to get onto the grid, you have to sort of book a place, and there's a long queue ahead because the National Grid isn't actually geared up to take on more connections. There's planning permission and so on. Takes a long time these days just to get this plant onto the grid. So some UK-specific issues there, whereas Gore Street, which is diversified, they've actually done relatively better. But they're all on big discounts, as you say, 40% I think in the case of Gore Street and almost 70% in the case of Harmony Energy Income Trust. It'll be interesting to see what the boards and the managers have to say about it when they next say something about the valuations. Maybe they'll have to do something to correct them. Would you think that's likely or possible?
Well, I think you're right. I think we'll all be watching the next announcements very closely. I think there are several moving parts here. One of the important ones is the dividend, because both Gresham House and Harmony Energy have passed on the dividends and may continue to do so. They may not pay the next one either, whereas Gore Street at the moment is toughing it out and paying its dividend. And you're right, it has some protection from its international diversification. But we are likely, I think, to see those NAVs coming down, partly because they're based on future power prices and the curve is worsening. And yes, I don't know what else the boards will do. They haven't got the cash for buybacks, so that's not going to happen on any significant scale. But I suspect actually this is just one of those unfortunate situations that will gradually correct over time. And so we may not see a very sharp and obvious recovery that's based on any particular catalyst. It's just that slowly over time we'll realise these things are coming back into favour as their revenues rebuild.
Okay, so before we talk generally about some better things, but I think some of the regular candidates that we've talked about over the years just keep on grinding on with their sagas. I don't think we need to spend a lot of time over them, but it might just quickly cover them. We're talking about Digital 9 infrastructure, we're talking about Hipgnosis, and we're talking about Home REIT. I guess the most significant of those is the fact that there's going to be a investigation of what happened at Home REIT. I'm surprised there hasn't been one before now, frankly, because it's been such an appalling situation. I guess they've been waiting for the situation to clarify a little bit. So the FCA is getting involved. We're going to do a fraud investigation to see how this particular disaster evolved. But it's not particularly encouraging for those poor people who are still holding the shares in Home REIT. Fortunately, I'm not one of them, but there are obviously a significant number. What do you make of the latest announcement? I mean, it's not a surprise, is it? Let's be honest.
No, it's not a surprise, but I think many people will welcome this news that the FCA is launching a formal investigation. And I think what is interesting here is that the scope of the investigation seems quite full as far as we can tell, because it's covering a period from the launch of the trust, the very beginning, the launch of the prospectus in 2020, right through to the start of the problems. And there are clearly a lot of important aspects to look into here, partly the inflated prices at which these properties were clearly bought, and they're now being sold for discounts of greater than 60% to those purchase prices. Also, the fact that the portfolio was intended to be let primarily to local authorities for use by homeless people. And actually, again, that didn't really happen. And so much of the properties ended up in the private sector. So there's a great deal for the FCA to look into. What we don't really know is exactly what they'll be looking at, how detailed it will be, and what the potential penalties might be. But I think there's got to be a few worried people about, quite rightly. As far as shareholders are concerned, I think you're right, Jonathan. This isn't necessarily very helpful because potentially it's adding in one more complication and one more potential delay to the publication of the results. And so I think whereas in the last quarter of last year, we felt the shares were going to come back from suspension in Q1 this year, they seem likely now to remain suspended until the second quarter at the earliest. So it's very frustrating, I would imagine, for those shareholders who just haven't been able to exit at any price.
Yeah, and that's the one thing you want to do, isn't it, really? When you're involved in these situations, you want to see where the market sits, and then if you choose to unload, realise your losses, which will be significant in this case, obviously. But then, of course, unfortunately, the way things seem to work over here, you have a sort of long delay while we have an investigation and inquiry and to see what went wrong. And if you're hoping for some kind of compensation, because there's certainly questions to be answered by all number of parties, including the initial board, the promoters of the trust when it IPO'd, and so on. But if there is compensation, it will usually take an awfully long time to materialise. Even early now, we're getting to the end of the Woodford saga. So it's not a particularly pretty state, and it would be wonderful if we could actually get the shares relisted, and then I dare say the trust will eventually go to a better place. In the ground or in the sky. I'm not sure which it will be, but one of the two.
I don't think there's any chance of it having a continuing existence, no.
Well, let's briefly then just touch on, I have some sympathy for the troubles that DGI Infrastructure have had. They acquired some good assets, but their balance sheet was not able to cope with it the way the markets turned out. Couldn't raise any more money. So where do you think this one is going, and what have we learned here about this one?
Yes, poor Digital 9 infrastructure keeps getting hit by wave after wave of problems. And the latest of those is that the sale of its Verne Global holding, which is very significant, allowing it to pay down its debt and is the first step in its winding up and selling the rest of its assets. That's now being held up by a delay in approval by the Icelandic Competition Authority that has said it's going to instigate a phase 2 investigation, which sounds really bad news. And this is quite important for the trust because it is keen to repay some of its debt. And this is going to, again, push it out into the second quarter. But it's quite interesting. I'm quite frequently impressed by the depth of research that goes on from brokers and other participants in this sector. And in this case, one broker, J.P.Morgan Cazenove, really dived quite deeply into the workings of the Icelandic Competition Authority and saw that they do in fact waive most deals through, even after a delay. But they're not very well resourced. And, it's a small country, Iceland, and this is not a big competition authority. And sometimes they just need a bit more time to look through the details. And they wonder whether, in fact, that's what's happening here. And so whilst there was actually another big sell-off in the shares here on this news, which I think was really the result of shareholders just becoming thoroughly exasperated with the whole process, actually it seems that there's not necessarily much justification for a further sell-off here. And I think if you do currently hold the shares, if you can be patient, I think you might find that pays off quite well.
Yeah, well, I mean, they have come a long way, haven't they, in a very short period of time. I think in September they were still trading above 100p, and now they're at 18p. I mean, that is a serious loss of value, shall we say. And of course, it's a reminder of the old adage that the first cut is the hardest kind of thing. But when the bad news starts, if you can manage to sell your shares rather than hope for better times ahead, you'll often be well rewarded by doing that. But if you're still there, if you've still got the shares, then I guess at this page you're best just to hang on and see what happens. There might be something to come out of the wreckage here, because it's not as if there aren't some good assets in this business. It's just that we'd have to say it's been mismanaged at the top level in terms of balance sheet and so on. So let's move on from there. I don't think we need to spend much time on Hipgnosis songs, because that's just an ongoing saga. Shareholders have approved the payment of an incentive fee to try and get another bidder to come out of the woodwork. Have you got any more thoughts on that one, Andrew, that are worth throwing into this much debated topic?
It is indeed much debated, isn't it? Well, the other news was that the valuation agents have resigned, Citra & Cooperman, which was no great surprise because they were really publicly humiliated by the Hipgnosis board, who basically said we don't have any faith in the number they've come up with. So new agents will be appointed there, which I think will be helpful. I think generally what I take from this at this point in the process, Jonathan, is just that it takes quite a long time to resolve these problems. And this is the pattern we're seeing with Digital 9 infrastructure as well, and various other trusts that are working through their problems. It's not a quick process, and that's something you have to bear in mind as a shareholder if you are deciding whether you're going to stay in or sell out. When you're going through a professional advisory process and you're going through various corporate actions, it's a slow business because solicitors don't work quickly, and actually it just takes quite a while to work through all these things. But Hipgnosis Songs Fund, with its new board, does seem to be working through everything. It's making changes, it's moving forward, and eventually there will be some lights at the end of the tunnel. We don't really know quite what that will mean in terms of shareholder value, of course. And it could well be that this change in valuation agent knocks 10 to 15% off the stated NAV. But I'm not sure that has any impact on the share price, because I think there was so much pessimism about that NAV anyway. I think it didn't have credibility in the market. So we'll just have to see how this one works out, I think.
Yes, I think under the terms of the vote the shareholders had in the autumn, the board's got 6 months to come up with a new strategy, and presumably part of that will be a new valuation produced by somebody. But could that ever be extended, do you think? I mean, if they haven't come to the solution by the time this 6-month period ends, or is that actually not a scenario one should contemplate, talking as we are about the tendency towards delay in resolving matters, just the sheer complication of it all?
Well, these tend not to be hard deadlines. They're all set, I think, with good intentions at the beginning. But then, of course, life takes over, and sometimes it does take longer than expected. So, no, I think if the board is not in a position to really recommend a good outcome at the end of its stated period, it will extend it. So, no, this could rumble on for a bit longer yet. It's very hard to judge that, I think, and there's no particular end point that you could really stake your money on.
Yeah. So turning to slightly more positive news, or potentially positive news, one thing I thought I might mention to you, interesting developments at Pershing Square Holdings, which is managed by Bill Ackman, a well-known US investor, where they have held a meeting with shareholders last week, and they're talking about listing a new closed-end fund in the US. I wonder what you make of that and what the implications might be for Pershing Square Holdings over here.
Yeah, it's a really interesting one, Pershing Square Holdings. It's a FTSE 100 constituent. It's got a fantastic track record, and yet it's on a 27% discount, I think, something very wide, and has been languishing on a wide discount for quite some time. So it's not loved as perhaps it should be. And clearly, this is the case with many investment trusts, and there are all sorts of different strategies that are then employed, and buybacks are used, and there's all kinds of ways that boards are trying to narrow those discounts. Most of them don't work all that well. And so Pershing Square Holdings is trying something quite different, and it's effectively listing a sister fund in New York, which will invest in the same things. And some of the fees actually will flow back to Pershing Square Holdings. So this could be quite beneficial for the trust. And it's received actually quite a decent response from the market. I think this seems like quite a good idea. It's something a little bit offbeat. And we're quite used to seeing that from Pershing Square, which, goes its own way. And Bill Ackman has his own way of doing business. But he's a shrewd character, and he does tend actually to get things right. So I'll be interested to see how much money is raised. This is going to be quite a big fund. It's a big fundraising in the US. And I think we may find that it raises much more money than is currently anticipated. in which case the benefit to Pershing Square could be even greater. So to me, it seems very supportive.
Yes, because one of the interesting things about this, as you say, it is a member of the FTSE 100 index. I think apart from Relics, it's the best performing share in the FTSE 100 this year. But the interesting thing is, of course, why is it listed over here in the first place at all? If we go back into history, there are, I think, a number of reasons why that happened. But one of the consequences of that is that a lot of US investors can't, or for technical reasons, aren't able to invest in London-listed closed-end funds. And as a result, therefore, Bill Ackman is much better known in the US than he is over here. And so it's always been a slight oddity that he and the board have complained about the fact that they're on a big discount. But of course, they don't have the benefit of a lot of US demand for the shares coming in, which is the natural supporters. So it'll be interesting to see. I mean, I can't now remember exactly why they listed in the UK, but actually I think it was for regulatory reasons back in the day when they actually started over here. So it's got to come full circle. But as you say, his track record has been very good recently. Anyway, the last 5 years have been good, and it'll probably go very well. I think he's a high-profile figure in the US. And it's an interesting vehicle as well, isn't it? Because it invests mainly in US equities, fairly concentrated portfolio of US equities. But it also has made very effective use of put options and so on to protect itself during market sell-offs. So I think it will be interesting. And I guess the proof of the pudding will be in the eating. We'll have to see whether the discount does narrow. They've done a lot to try and get the discount in a little bit, haven't they, the board of Pershing Square Holding? Interesting to see if they can make some more progress on the back of this particular initiative. I suppose the downside, the negative of this is that he's going to be very preoccupied with getting the listing away, raising the money over there, and his attention will be divided in future. He won't be so solely focused on the US, on the UK listed vehicle. Do you think that's a danger one should be worrying about?
Well, in the short term, you're right that obviously his attention will shift somewhat to the fundraising. But I think beyond that, it's fine, actually, because I think the business effectively works holistically and whatever he's doing gets spread across the business. And so I'm not too worried about him starting to focus on the US fund at the expense of Pershing Square Holdings. And I'll just come back on something you mentioned there about the track record. It's such an interesting trust, this one, because its fundamental basis is in a very conservative portfolio of US equities. And yet, on top of that, there's this overlay of Bill Ackman's own sort of hedge fund activities, which include the put options and whatever else he fancies at the time. And I think those investments that he's made or proposed for Pershing Square Holdings have often been quite offbeat, quite unexpected, and certainly idiosyncratic. And that's maybe part of the reason why British investors who don't know Bill Ackman terribly well are slightly wary of the trust, and maybe that's why it trades on a discount. But he does have a very strong track record and has benefited enormously from most of these big trades he's done.
Yes, the only thing I'd add to that is I noticed this week that we heard from AVI Global Trust that they've actually sold out of their position in Pershing Square Holdings. That's one of their bigger positions they bought a few years ago to benefit from what they saw as an unwarranted discount. So that's interesting. You might have a look at their reasons for doing that. Finally then, Andrew, we said we finished on a positive note. There haven't been a lot of results from particularly large or interesting trusts so far this year. There have been some decent performances and some not. But one I picked out from this week's list, I don't know if you have followed this one at all, and that is the Brunner Investment Trust, which is a trust managed by Allianz. And it's done extraordinarily well. Its latest results showed, I think it was beating its spend part by about 3%, but it's been on a pretty strong run for the last 2 or 3 years at least. And it's originally one of those family investment holdings. It was the Brunner family, who were one of the families that helped to start ICI back in the 1920s. But it seems to have found its sort of legs after a period that wasn't so good before. What do you make of this one?
Yes, it's quite a low-profile trust, this one, actually, in the global sector. It's not a trust that attracts very much media attention. And that can, of course, be a good thing, because it means it's not had any problems. But its track record, I think, was lackluster for quite a few years. And I've been quietly aware of this trust for probably 30 years or so. And for most of that time, it wasn't really a trust that was at the forefront of my thoughts or indeed top of my buying list. But actually, over the last 5 years, its track record has really improved quite sharply. And I think partly that's because its more value-based approach has come back into fashion. And I think partly as well that some of the growth competitors have fallen away. But it has done quite well. And of course, it's not just the capital returns that are important here, but the dividend, which is covered by revenue and has grown for 52 years. You know, this is one of the AIC's dividend heroes. And I think there's quite a lot to be said for that list. But I don't know, the dividend, although it's been going up, it's still actually quite low. It's a 1.9% yield on this trust. And so I don't think you're really buying it for the dividend. You're really buying it for the global exposure, which does include companies like Microsoft, which have done very well for the trust. And in fact, I'm really quite impressed that the managers have managed to outperform over these recent periods, because the trust has an unusually high exposure to the UK for the global sector. It's about 25% of its assets in the UK, which of course has generally been a headwind. The UK has been underperforming the rest of the global markets, especially the US. So the managers have done well, I think.
Yes, I looked at the 5 and 10 year record now, and it is about 11% per annum annualized over the last 5 years and about 10% over 10 years, which is pretty reasonable, it has to be said. But that's pretty much still in line with the FTSE World Index. So basically for a global equity trust, it's done okay, but it will never shoot the lights out, I suspect. But it's worth acknowledging anyway as we go through these. Some of these longer history trusts, which, as you say, don't appear much in the public prints, but they are putting in a steady shift anyway, should we put it that way?
Well, they are, and there's so much to be said for that, Jonathan. Obviously, in a weekly podcast, we're talking about the news and we're talking about trusts that have been active and doing something in the market. And often that's quite negative because things have been going wrong. But actually, there is, of course, this large bulk of trusts working very quietly away in the background with equity managers who are just getting on with their job, as they always have done, quietly producing quite good returns for their shareholders with the benefits of the investment trust structure. So you have the revenue reserve to support the dividend and smooth it. And you have the independent board and you have the potential to gear. So I think it's quite easy to overlook all of these quiet trusts that are doing a good job for investors who will generally hold them for the long term. And actually, those figures you just quoted from Brunner look very nice if you hold it over the years and you compound your wealth.
Yeah, and we saw that this week. I mean, we should end on this note. The AIC puts out regularly this annual list of trusts that you could have made $1 million out of if you'd invested your full ISA allowance every year for the last however many years it happens to be. I think they're up to about 30 years now on their list. And yeah, compounding is the thing that makes your wealth over time. We can all agree on that. And many investment trusts have a long history of doing just that. So thank you, Andrew, for your time and thoughts this week. I look forward to having another chat in due course. And let's hope that the news picks up a little bit from here. And we shouldn't concentrate so much on the negative stuff, perhaps, but that's what hits the wires every week.
Indeed it does. We'll keep our fingers crossed, Jonathan.
Thank you for listening. The Moneymakers Weekly Investment Trust podcast is independently produced and edited and is listed on all leading podcast channels. You can also sign up at the website money-makers.co to be notified every time a new podcast is available. Please note these podcasts are provided for educational purposes only, and nothing you have heard from any of the speakers should be regarded as constituting investment advice. If you want more news, analysis, interviews and other investment trust content, don't forget to look at the Moneymakers Circle, available now for a modest subscription at the website.